Hello everyone, hope you're doing well. We will begin today's class with a quick check on how many of you did your homework. Remember I gave you a homework around Black Seas. So let me check with few people. Priyanka, quickly tell me the countries surrounding the Black Sea.
Sir, I did not do it. I forgot. But as I can remember, it was Turkey, Ukraine, Russia.
That's not the complete list.
I'm sorry.
See, I think journey is going to be easy as long as you are doing things along with me. It was simple homework. You just had to look at the world map, identify Black Sea. And when you were identifying Black Sea, you would have also stumbled upon various other kinds of seas. Could be Red Sea, could be Mediterranean Sea. But it's a habit that you have to build over a long drawn process. You will not learn things on the last day. You can't leave things for the last day. And these are easy marks in prelims examination. Every paper will have map-based questions. Even if you remember all these names, you will have to re-revise these names. Look at the map again, because there's a high likelihood you will forget it. UPSC will ask you questions not exactly on Black Sea, but around Black Sea, around Mediterranean Sea, Caspian Sea. Amisha, can you tell me the countries around it?
So Ukraine, Romania, Bulgaria, Turkey, Georgia, and Russia.
Is Greece part of it? Don't look, just tell me.
No,
Are you sure?
I'm not sure, but Greece is
You should
not
be
the
sure. It is not part of it. When you will look at the options, you will then sense the confusion. Let's look at a couple of questions that UPSC has already asked around this question. And it will continue to ask. And all of you, please unraise your hands. In the meantime, while I'm searching for the question, please have your map ready. Look at the map. Look around the Red Sea, Med Sea, Caspian Sea. Just make observations. Okay. Kirti, let's solve the first question, 2008.
Sir, I guess Black Sea.
No. Just discuss Black Sea, countries around Black Sea. Was any Malta mentioned?
No, sir.
Then why Black Sea? You can't make such simple mistakes. Just a few seconds ago, this was told. No matter how much hard work you put in, how much of guidance that you acquire, but if you make such simple mistakes, you don't deserve to be in services. So please be diligent. Please listen to things carefully. It's a UPSC question, not making it up.
Yes, sir.
I'm not telling you the answer. Swati, solve the 81st question. Turkey is located between what?
I believe it's the Black Sea and the Mediterranean Sea.
These are the kind of questions that you will be asked. These are the questions that are being asked. Let's look at this question, the next one, 2019. Shall give it a try. Are you answering it?
I'm actually checking it out, sir.
Take a screenshot. Not just you, everyone. Take a screenshot if needed. So I'll stop sharing the screen. I want to see your faces. Even if you just knew the countries around Black Sea, you can correctly answer this question by eliminating. These are not made up questions. UPSC has asked these questions. It will continue to ask these questions. Sometimes around Red Sea, sometimes around Caspian Sea, Adriatic Sea. And these are simple questions that you have to answer in any case. What's the point of studying for 2 years, 1 year? When you know the questions that will be asked, you will not be prepared for it. So as a homework, again, after today's class, look at all these C's. I will ask questions. Okay? And just listen to things carefully, apply logical conjectures, you know the answers. Even in the eventual examination, no one will be 100% sure of all the options, of all the answers. You will have some bit of information about everything. It depends upon you on how you use that already acquired knowledge, already acquired information. You will spend all your time thinking, we have not studied this or that. There are so many things, so many easy things that will get you an easy pass through this examination, at least in the first stage. Most of you will fail the first stage. Let's make sure that we clear that first stage. So let's come back to economics. Yesterday we saw one thing, an easy thing. We saw that if RBI increases interest rates, what happens? Sumant, let's assume if RBI increases interest rates, what could happen to the money supply in the economy?
If RBI increases the interest rates, then the money supply in the economy will come down.
Exactly.
Because,
And when money supply in the economy comes down, what could be the effect on inflation?
the inflation could decrease.
Good. So we all understood that interest rates are very important tools. No doubt about that. It is via playing with these interest rates, central banks can control money supply. And by controlling the money supply, central banks can tame the inflation. We saw that relationship yesterday. I think now is the perfect time that I introduce you to a very interesting term. And this term is called as yield. 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 What is it? Economists, bankers, they love to complicate simple things. They make a lot of use of the term called yield. Diksha, what is yield? I've asked you to unmute yourself. You can't do it. Sachin? Sorry, Angad. Go on.
Sir, so can you hear me?
Yes.
Yield in basic layman terms, it will be same as return or whatever we can accrue out of an investment. That is what I think.
You're right. Yield is another term for interest rates. In the world of finance, in the world of investing, yield refers to the earning generated on an investment over a particular period of time. Can anyone give me an example of the statement that I just made? You can understand things only if you can connect with examples. Ishan?
Sir, here we can explain yield as, suppose if today I invest 100 rupees in any stock on the market that is listed on any of the market, and if I sell it after 5 years for say 500, then my yield is 400, or my profit is 400, so my yield out of it is 400.
So
So the same thing. If I buy a government security, for example, so let's suppose if I invest 100 rupees in a government security for a period of 1 year, and let's say the government tells me after 1 year I will give you an annual interest of 8%. So after 1 year, how much I will get in return? 108 rupees. So my yield in this investment is 8%. Now let's suppose after 6 months, in this case, this is the second case I'm talking about. Let's suppose after 6 months, I feel like I am in need of money. I do not have money. I have already paid 100 rupees for a government security and I need certain amount of money. What should I do? So I will go to Naman Bhaiya and give him my government security and tell him that please buy my government security and give me 100 rupees. He will give me 100 rupees, but or give me 90 rupees, for example. Okay, Naman Bhaiya will buy my government security at 90 rupees. After 1 year, the government will give Naman Bhaiya 108 rupees. So for Naman Bhaiya, the yield would be 108 minus 90 divided by original investment. So he will get a yield of 20%. I got a yield of 8%. Similarly.
okay. For all the newbies, do not be worried. I'll explain it right now. Okay. Let's assume that you invest in a fixed deposit with an Indian bank. Is anyone who does not know what is a fixed deposit? There could be many. No shame in asking. There are many personal finance YouTubers who say that you should not invest in FDs. Why? What's wrong with FDs? They should rather invest in stock markets. We will tell you which stocks to invest in. Don't invest in FDs. Are they correct? Aman, what do you think?
So I think stocks are more dynamic. That's why they recommend us to do so. But there's also risk with it.
Let me
These
ask you a
are
question. Let me ask you a different question. Why do people invest money?
to increase revenue.
Swati, what do you think? Why do people invest money?
Well, if you talk about
common citizens, I believe, it's for personal financial security, and for businesses, like Amin said, it can be for revenue generation.
I can ask hundreds of you the same question. Many of you will have different answers to the same question. And rightfully so. Why do people invest money? Some will invest to protect their money. Some will invest to make a lot of returns from that money. They think money will make us more money. Some just have a goal that it's a hedge against inflation. There are many examples of many people who earned a lot of money, but they went broke. Why? Because they could not protect their money. Protecting money is not easy. Mike Tyson, a heavyweight boxing champion, he filed for bankruptcy in 2003. Throughout his career, he made millions of dollars. At one point of time, his net worth was more than $300 million. What happened? Bad financial planning. And then he was in debt for $23 million when he filed for bankruptcy. Nicolas Cage, same story. Not just in the US, even in India. Byju's, forget about Byju's. We'll come to that example. In fact, in India, founder of Cafe Coffee Day committed suicide. One of the reasons, of course, there were many, but one of the reasons was he was neck deep in debt. Byju's was doing so well. A few days ago, one of the newspaper articles went viral that he was crying. He's unable to handle the scrutiny from media, from investors, from parliamentarians. His company was doing so well. But then he made a mistake of raising money from sharks. They're called as sharks for a reason. We don't call them dolphins. We call them sharks. Why? They're sharks because they're aggressive. They're aggressive in their single-minded pursuit. What is their pursuit? The pursuit is about profits. They want to make as much profit for themselves as possible. They will negotiate term sheets accordingly. These investors or sharks, they are not friendly like dolphins. Many a times they will eat you. There are many examples. Ankini Bose, eaten by sharks. She was the founder of Zillingo. Very often we see these newspaper articles. I raised $2 million for my startup. Or I raised $7 million for my startup. See, raising money for startup, and proudly talking about it is exactly like buying vegetables for food. The money that you have raised for your startup is a resource, like the vegetables. You need vegetables to cook food. You need money to build your companies. The money that you have raised is not free of cost. Investors who have invested their money, they are not doing you a favor. They expect returns from you, from their investments. In the past few years, as an investor, I've signed many term sheets. Term sheets is a document, contains a lot of terms. CAs would know it. I've helped many of the founders sign those term sheets. And in front of my eyes, I was astounded to see the glaring mistakes these first-time founders make while raising money. What do you think is the most important thing for a founder? Without even asking, I know the answer. Many of you will say valuation. It's not valuation. all the conversations with the investor hovers around valuations, not value. Many a times, these founders don't even realize the importance and value of simple terms in the term sheets that they are signing, be it liquidity preferences, or who will control the board structure, so on and so forth. And there's a reason for it. They are not at fault. Think from the investor standpoint. Investor is signing almost 3-4 term sheets every month. But a founder, entrepreneur will sign the only term sheet in their lifetime. They do not know how to negotiate those term sheets. They might hire lawyers, but these lawyers will also do shoddy jobs. Think about this. Why would they do shoddy job? Think. Who gives them more business? Founder or the general partner, the fund, Sequoia? Those investors give lawyers a lot of contracts. Founder has a tiny company. Investor has multiple companies. Of course, his priorities should align well with the investor, not the founder. But anyway, why do we invest money? Because we want to protect money from inflation. Some may want to grow that money. Many influencers will tell you that inflation will eat your money. And yes, they are right. In fact, this fear of inflation eating your money will make you lose a lot of money. Because this is one of the fears that will be used by financial influencers to upsell their product. And subconsciously, many of you, in your desire, in your quest for more returns, end up investing in your life's savings on very risky assets, be it the altcoins, be it the NFTs, be it the multi-bagger so-called equities. Because many of us want to become millionaires in 2 years without much hard work for it. So we take those risky bets. It's like playing casino. Thankfully, some of it is illegal in India. That lottery tickets nonsense. So talking about FDs, giving these blanket statements that do not ever invest in FDs. FDs are useless. These statements are useless. As influencers are making those statements. We can't make such blanket statements. Your investment decision depends upon what is your age, what are your goals, what is your risk appetite. It is personal finance for that exact reason, not public finance. Sachin, any thoughts?
So I just thought of an example that influencers saying FDs are bad. So there was a news article from Nitin Kamath himself, the founder of Zerodha, that around 56% of their revenue goes to FDs. So this is the biggest example of diversifying what you do. And again, not relying on those influencers. As you rightly said, it's all about risk appetite, the amount of money you have, and you have to diversify. If I put my all money in the stock market, instead of becoming a millionaire, I might come to streets. But if I am diversifying my portfolio, I might lose my money in the stock market, but I might still have the money to serve my essentials. So this is the thought I had in my mind to counter that thought as well.
But yeah, one thing to note is, and it's a very important thing to note, it is a personal finance, not public finance. Always hedge your portfolio. If you were to invest money, hedge it. Put some money in equities, put some in real estate, put some in cryptos if you are craving for adventures in life. Put some money in FDs. Nothing wrong with that. Where else should you invest? Rohit, where else should we invest?
Yeah, we can invest in gold, commodities, and I would like to add one point why so-called influencers
Hold
tell
on,
don't
we'll come to
invest in
that.
FDs.
So Rohit mentioned, let's invest in gold and commodities. So, and that is the misconception that many of us in our 20s have. And one misconception is that investing is just about investing in money. You must think beyond the metric of money whenever you hear the word investment. You don't invest in money, you invest in creating wealth. What is the difference between money and wealth? I want to talk to all of you who are at that juncture in your life, and you should understand the meaning and difference between money and wealth. Money is merely one type of wealth. Knowledge, time, health, relationships, experiences. Sometimes they are much more valuable than money. And all these parameters, including money, leads to creation of wealth. Money is important, but money is beyond money. It's wealth. And wealth will have many other components, many other parameters. Invest your time not just in gold, equities, but also in learning skill sets. If you can be the best of whatever you're doing, you can charge whatever money, price for your services. Richest people in the world, they're not always stock market traders. They are creators. And they can create only when they acquire skills. A.R. Rahman creates music. Jeff Bezos, Elon Musk create businesses. J.K. Rowling creates stories. Sachin Tendulkar creates magic, just batting. Steve Jobs is not a stock market trader. He's not giving you advice on which stocks to buy. He creates companies which have definitely transformed many aspects of how we think. So invest your time in learning skills, invest your time in experiences, and please learn to distinguish between wealth, what is wealth and what is money. So let's come back to the concept of yield. Yield is just another term for interest rates. In the world of finance, in the world of investing, yield refers to the earning generated on an investment over a particular period of time. So I hope FD is clear. So let's assume that you invest in a fixed deposit with an Indian bank. Fixed deposit is a type of financial instrument that offers investors a return for the money that they invest in over a period of time. FDs are generally considered to be safe, reliable form of investment, popular in many countries, including India. So let's assume, Aman, let's assume that you invest in a fixed deposit with an Indian bank. Okay. And that bank offers an interest rate of 7% per annum. So if you invest 1 lakh rupees, how much interest would you receive in 1 year?
So 7,000.
7,000. In this case, the yield on your FD is what? How many percentage?
So 7%.
Calculation, 7%. Income from investment, cost divided by cost of investment multiplied by 100%. So how much income from investment? 7,000. Cost of investment, 1 lakh. You will get 7%. So basically, what is yield doing? Yield is giving you a standardized way to compare the returns on different investments. For example, if there's another bank that offers you an FD with an interest rate of, let's say, 8%, you can immediately see and make one conclusion, that it has higher yield and there's higher return than your current investment. So we all understand yield, simple concept. It's a very general concept that refers to the income returned on an investment. But now things become very interesting. When you plot a curve between the interest rates and time period, you get a new term. And that new term is called as the yield curve. And it is this yield curve which is a very important concept in finance. Yield curve. This yield curve is magical. This is the term that you will use in most of your mains answers also. We'll tell you how. In fact, many investors made millions of dollars by just studying and analyzing these yield curves. Now, to sketch a yield curve, you need two things. You need yield, that is the interest rates, and then you need time period, also termed as maturity. Now, let me show you these two things for two different countries, banks of two different countries. One will be for India, the other one will be for Pakistan. Okay. To all those who are listening this for the very first time, don't be stressed. Just listen carefully. So let me show you the FD rates of the HDFC Bank today. Just observe it, take a screenshot, and then tell me what do you see. But take a screenshot, it should be saved because I will use it in the lecture coming forward. So I just opened the HDFC Bank's site. These are the interest rates on FD. Look at this. 7 days to 14 days, it's around 3%. 1 month again, around 3%. Let's look at 1 year, 6.6. Let's look at 5 years to 10 years, around 7%. Okay. Particularly note this 10 year, 5 years, 10 years time frame, 7%. Note about 1 month, 3%. And note about 1 year, 6.6%. Cool. Now let me open it for a Pakistani bank, because we will make few conclusions about the economy of these two countries by studying the yield curve. Now this is for a Pakistani bank. Look at the 1 month deposit. Compare that to the HDFC. Look at the 1 year deposit. And look at the 5 year deposit. Even for HDFC, we looked at 1 month, 1 year, and 5 to 10 years. Take a screenshot. Now, what I'm going to do is, I'm going to create breakout rooms for 5 minutes. And your task is extremely simple. You just have to sketch a yield curve. There will be x-axis, there'll be y-axis. I'm sure you must have studied this in class 10th or 9th, I don't know. Basis whatever you sketch, we will make a few observations about the economies of the country. I just want a rough sketch. I don't want you to plot with numbers and data. Just want to look at the rough sketch. Basis that sketch, tell me the shape of the yield curve. Is it changing or not? Simple. Mukul, can you have your video on before you ask the question?
Hi, Namaskar.
Yeah, go on.
I have a query uh, about last class.
See, let's move on with the way we are progressing. Otherwise, syllabus completion will not take time. Whatever we're discussing, let's discuss things on the go. The query about the last class, we'll do it later. But right now, let's focus on what I've asked you to do. Is there anyone who has a question about this task? Okay, I'm creating breakout rooms. Please work on this diligently. It's an important concept. And many things will join together in some time. I'm just telling you some bits and pieces of various concepts. It will take time for you to acclimatize to economics. Just be patient.
Guys, I think we should do the conversation. Am I audible?
Yes, you are.
Perfect. So, did anyone already plot the graph? Have we done with it?
I'm doing the one for HDFC. I think I'll be done with the Pakistan.
Okay. What I was able to observe was if we plot the interest rate against the time, the HDFC was a linear increasing graph, like almost straight line, right?
Yeah.
And when we observe it in case of Pakistan, the Pakistani bank, we see a U-shaped graph. Like they have their highest interest rate at 1 year, that is 20.25, and then it's decreasing. Like they have their lowest at 13%, like the 5 year, while our highest is at 5 year. So does anyone has any observation on that?
Hello. I
Hi,
have an
Ganesh.
observation that in India, we can say that the economy is a bit stable. So the return rate are not that much fluctuating as in case of 1 year, 1 month, and in 5 months, 5 years. Sorry. But in case of Pakistan, we can see that as they are in a huge crunch of money, so that's why for 1 month and for 1 year, they are giving a huge amount of return rate. But since they are not able to. But in case of 5 years, I think so they are not predicting the economy to be stable in such a manner. So it's not that much. But in case of 1 month and 1 year, it's huge because they want a huge influx of money as of now because their economy is going down.
Makes sense.
So
Like they're offering such high rates just to extract the money for the economic development, and they promise they're not sure whether they will be able to deliver on the promise or not, and that would lead to
exactly.
a higher crisis if we see that.
Yeah, but in case of India, we have a bit stable economy, so that's
Yeah.
why initially it's like 3% and 6%, but in the case of 5 years, it's like a bit only 1% rise. There's only a difference of 1% between 6% and
Exactly.
7%.
In India, we are promoting like the time maturity. Like we are promoting investment for a longer duration rather than focusing on the initial development. Like, can we say that we are focusing more towards infra projects or anything long duration, long gestation projects? We can say that because
Exactly.
project is that. We can say that.
For those like who might have not understood, basically we mean to say that India's economy is very stable and that the rates are progressively growing as it should be, and in Pakistan it's like very unstable. As you can see, it's going from 1920 to suddenly 13. So it's not proportionate. So it just reflects that the banks are going through a hard time in Pakistan too.
Vishwajit, CTIM.
So in India, why is it so that 1 month to 1 year, it's 3% to 6%? All right. Then from 1 year to 5 year, just 1% increase. Why is this a notion? Is there any reason behind it?
I think this is generally followed over banks. I can't remember as of now, but yeah, like you're saying that it's increasing more from 1 month to 1 year and less from 1 year to, like, let's say 5 years. I think that's how, like, I don't know what it's called. It is a phenomenon. It's followed by banks. And,
It could also be a social behavior kind of thing, the mentality set in people. Like, for
no, this is
example, if we see
interest rates just progressively decline as as and when time increases, as and when the time period increases. So I don't know what it's called, but yeah, we also observe that.
yeah, the people would also go for like the normal. If you compare it with the any company strategy, if I see a offer that is like, okay, I can invest for 5 years and get a better deal out of it, then and if I don't need the money, then I would prefer that rather than investing in market, even if I see a difference of like if I don't need the money, that's the case.
I think it's also because like FDs are like less dynamic than stocks. You don't have so much yield as far as like if you would have in stocks. So that's why it's like less. And because I think it's also to do with how a lot of middle class people invest in FDs. So for them, even like a small rate of interest, which is like it might look small to us and less profitable, but it's fine for them because all they want to do is secure their money.
Actually, I don't understand what FD is. My background is not there.
Can I explain? I just did it in my 12 boards and info. So FD is basically where you invested for like a certain period of time, your money, and you can't withdraw it before like the maturity period. But in reality, a lot of people do withdraw. And when you withdraw your money before the maturity period, the bank like you have to forego the interest rate at which you initially invested the money. Like the bank cuts the interest rate, so you make less profit if you withdraw it before maturity.
I
So
think
basically,
then it's a
the
loss now.
interest sum is go on. What is it?
I think it's a loss if I invest something and I get it out before maturity period, then I'll have to pay
Loss.
that very
If
interest to the
I
bank.
promise to get it out at like this date or like whatever maturity period was it, but मैंने उससे पहले अपना पैसा निकाल दिया, so I'm at a loss. Banks will penalize me for it, so they penalize us in the form of.
But your initial sum is saved. Basically, you will get the initial
Full amount is there.
Yeah, you'll get the interest rate lower. Basically, like rather than getting 7,000 rupees, you might get only 2,000 or 3,000 rupees. That's the disadvantage.
Oh.
I can make a conjecture in regarding that why the difference between 5 year and 3 year is just 1%, because I think so when we are investing for 3 years, there is a certainty that the market would be fluctuating a lot. There would be a time when the market will go bear, and at some time it would go bull. So, but in case of 5 years, I think so that's a time frame which in which most of the market is stable. So that's why the
All right. So once in a while, it's good to look at maps. But so when you were gone, I also decided to draw the yield curve. I'll just call out someone and ask that person. So my drawing is terrible, but I think it will serve the purpose. So definitely on x-axis, we have maturity. On y-axis, we have the yield. Okay. Now you will have to identify, looking at these two yield curves, which one is for India, which one is for Pakistan. Ankit?
So the first one is for the Pakistan, and the second one, which is increasing constantly, is for India.
Okay. And everyone understood? Very simple way to plot it. Can you explain this? How, why, which one is for India, which one is for Pakistan? Just explain this to the class. Let me check with the Siddhika. Can you explain this to the class? Which one is for Pakistan, which one for India, and why?
So the first one is for Pakistan. So first of all, when we see whenever the riskier assets are there, we have to give higher rate of interest. So in Pakistan, the economy is like shrinking. So the interest
No,
rates
we
are
didn't
higher.
have to do anything
Whatever.
we have to make no conjectures as of now. Just by
Okay.
looking at the interest rates and the
Okay.
maturity, we plotted
Okay.
this.
So
Simple task.
okay. So when we see like for 1 month, it's approximately 19.5%, and for 1 year, it's 20%. Rate of increase is there, but it's very minimal. It's approximately stagnant. But then suddenly after 1 year, we see a huge decline. Like it approximately reaches an inflection over there. The huge decline is there, and it goes up to 13%. So we can see the rate is declining at a very fast rate after reaching like after 1 year or something.
Yeah.
However, in the case of India, we see that it's continuously increasing. So the rate of increase is very much in the like from first month to the 1 year, and afterwards also it's increasing. Though the rate is means the rate of increase is decreasing, but still it's on an means like increase path.
Okay. I think just it was a simple way to plot. Of course, nothing complicated up until now. We just looked at the interest rates that were offered by HDFC, and we plotted this the way we have done in class 6th and 7th. We can't go back to that learning now. We have done that exactly for the Al Habib Bank from Pakistan. It's plotted the rates that they are offering against the maturity. Okay. But now the magic starts once we have roughly plotted this graph. Next 15-20 minutes, we'll talk about that magic. It was a rough sketch. But one observation is Indian context represents a scenario of normal yield curve. The way we saw for Indian context, it's a normal yield curve. That is how a normal yield curve looks. Long-term bonds do provide higher yield than short-term bonds. Can anyone explain this? Why is that the case? Why long-term bonds provide higher yield than short-term bonds? Janani?
Sir, it's because with time, obviously the interest rates can be increased because of how the economy turns out to be. If I could make one conjecture, if
No
not,
conjecture. You have to just tell me long-term bonds versus short-term bonds. Generally speaking, in normal circumstances, long-term bonds provide a higher yield than short-term bonds. That's a fact. Therefore, it's called as normal yield curve.
yes,
Now, my question is, can you explain
yes,
this?
sir.
Why?
Because in long-term bonds, investment will be more, right? I mean, there'll be consistent investments in long-term bonds. Or maybe I'm confused.
Okay. Sindhu, can you explain?
Can you hear me, sir?
To all those who are not able to understand, listen to them. And of course, then I will obviously explain this in detail. But you also start thinking. It has to be active learning. It's a new thing that you're learning for the first time. Go on.
I'm not really sure of it, but what I can say is
And hold on. Someone who is very sure, only you keep your hands
money
raised.
for long term.
Only those who are sure to explain this correctly to the class, only you keep your hands raised. No conjectures for this question. Fatima, go on.
So what I think is it is because long-term bonds, the money that is taken out is huge, and the investment that is made is in something that gives more returns. Of course, there's more risk involved, but the returns will be also very high. But in the case,
hold on. Let's assume that I ask you this question in UPSC interview. How will you answer this? The question is simple. Long-term bonds, generally, in normal circumstances, provide higher yield than short-term bonds. I'm asking you why. Vijay?
It's because the money which we invest is going to be with them for a longer time, and so they can invest in some place.
Exactly. Simple answer. This is because long-term investments are riskier. And therefore, investors demand higher returns to compensate for the additional risk that they're taking. Think logically. Suppose you are an investor and you have an option to invest 1,000 rupees, either in a 1-year bond that pays out an annual interest of, let's say, 2%, or a 10-year bond that pays out an annual interest of 4%. What does it mean? It means if you invest your money in a 1-year bond, your money is tied up only for 1 year. And at the end, you receive your principal plus interest back. Your principal of 1,000 rupees plus your interest of 20 rupees in this case, 2%. On the other hand, for a 10-year bond, what happens? It means if you invest your money is locked in for 10 years. Even though you will receive a lot more interest each year, but not your principal. Risk is higher in this case. Longer time horizon. So many things can go wrong in those 10 years. Drastic changes in economy do not happen in small time frame. But dramatic changes can happen in 10 years time frame. Go back 10 years ago, India, no chat GPT, no UPI. See how things have changed in 10 years. But 1 year, we can make guesses. Yeah. Silicon Valley Bank. We all know about it, right? Silicon Valley Bank. Why did it collapse? It invested a lot of money in long-term US Treasury bonds. Of course, there were many reasons, not just one of the reasons, but this was one of the reasons discussed. And when interest rates, they started rising sharply around that time, depositors demanded money. They demanded higher return. And that Silicon Valley Bank was forced to sell some of those bonds at a loss. Let me show you a video of why it collapsed. So longer a duration, higher the risk. That's one thing, logical. I know we did not start with a video today, but I'll show you a lot of videos today, approximately 3-4 videos.
for the banking industry.
The collapse of Silicon Valley Bank, the second biggest bank collapse in U.S. history.
The Silicon Valley Bank collapsed on March 10 after a run on deposits doomed the tech-focused lenders' plans to raise fresh capital. This prompted US regulators to step in with emergency measures, including seizing another bank 3 days later, in a bid to ease fears that depositors might pull their money from other lenders. WSJ banking reporter Rachel Ensign explains how this crisis unfolded and what could happen next.
During the pandemic, Silicon Valley Bank had gotten all of these deposits. Their deposits tripled. It was a huge, huge, huge influx. And they did what banks do. They took some of the deposits and made loans, but they also invested a lot of them in securities, which are pretty safe. Some issues had been bubbling under the surface at Silicon Valley Bank since the Federal Reserve started raising rates. When rates rose, the bonds fell in value. It's not a big problem for you unless you have to go and sell the bonds. But deposits started leaving the bank faster than they anticipated, and they had to sell their bonds and take a very big loss. The bank made an announcement on Wednesday night that it needed to raise capital and was planning to do that the next day. The investors completely freaked out, sold off the stock, and then a bank run started where people tried to withdraw $42 billion in deposits just in that one day. And by Friday morning, it was seized by regulators. The regulators have responded in a way that they're hoping stems the panic. The Fed said, we're going to be offering this lending facility that's a backstop. We're going to be insuring all of the deposits effectively of this bank that failed.
So basis all the discussion, one thing should be clear, that long-term investments are considered to be riskier. And therefore, because of the risk associated with it, investors demand a higher return to compensate for the additional risk that they're taking. Investors are taking many risks. Can anyone tell me what are the risks that investors are taking when they invest in the long term? Rashika?
I think one of the major thing is they'll not have the liquid cash.
Let's assume that if you have an option to invest your money in HDFC FD for the long term, let's say 10 years, and you're being provided 7% return for your investment. What are the risks that you're currently taking with that investment?
That 10 years, my money will be locked. Of course, there's a chance in FD that I can withdraw the money, but
still,
still it's not that liquid as it's in my savings account. That's one thing.
Number one is liquidity risk. What else? I'll explain what is liquidity risk in some time, but go on.
Yeah, and other thing, I would have got I would have used that money for some other thing which would have given me more returns. That is one thing. And the more, and there's a chance that of the bank going bankrupt, where I'll lose my money.
Yeah. Just think logically, you will figure out your answers. Another risk that we should have figured out is that interest rate risk. What if RBI raises interest rates? In case of bonds, I'm stuck with my 7% returns. But if RBI is raising interest rates, perhaps I can earn more money with that same amount of money. I think during COVID-19, a friend of mine at Harvard, he requested from Harvard to take a drop year. He did not want to study at Harvard at that time because he did not want to lock in his fees with Harvard for 1 year. He thought rather than paying fees to Harvard or paying for money to stay in Boston, it is much better that I invest in just such a fragile market. He made a lot of money back then. Perhaps There's no need for him to take educational loan. So opportunity cost is always there with your decisions. So one risk that we discussed is definitely the interest rate risk. What if RBI raises interest rates? I'm locked in with my 7% returns. What if inflation is like the ones in Argentina? There's something called liquidity risk that Rushika just mentioned. What is that? Long-term bonds are less liquid than short-term securities. What does it mean? When we say asset is liquid, we mean that it can be quickly converted into cash without significantly affecting its price. That's also important. I can sell my real estate tomorrow, but if I'm selling it for like 10 rupees, it affects my cash. It affects the price. So an asset is liquid when it can be quickly converted into cash without significantly affecting its price. Cash itself is perfectly liquid. Other assets have varying degrees of liquidity. So Vaishnavi, if we were to compare real estate versus stocks on Zerodha, which is more liquid between these two? And why?
Sir, stock market.
Why?
Sir, because according to the mere knowledge that I have, the settlements done in the stock market can be done within 1 day or 2 days.
You can quickly sell your stocks. But to sell your real estate takes a lot of time. Many a times you have to be physically present in various offices for signatures and all that nonsense. The concept that we're learning is the yield curve. So when you look at the Indian yield curve that I just showed, it is a normal yield curve. So in a yield curve that is normal, long-term bonds do provide higher yield than short-term bonds. Why? Because investors expect to be compensated with higher returns for the additional risk that they are taking. Should be clear to you now. But when the inversion of the yield curve happens, the way we saw in case of Pakistan, short-term interest rates become higher than long-term interest rates. Exactly what we're seeing in Pakistan. This is a negative signal for the economy. Just by looking at the yield curves, be it of government bonds or the FDs, you can make a conjecture. How is that economy doing? It's a negative signal for Pakistan economy. Now, can anyone tell me why? We'll discuss it, but I want you to think. Why is that inversion of yield curve a negative sign for Pakistani economy? And if you can predict that inversion for Indian economy, you make a lot of money if you're betting against it. Chandana?
Sir, maybe the short-term investments are more riskier than the long-term investments in Pakistan Bank.
Ishan, what do you think?
Where it is related to the fact that there is a high risk that over the long term, the money will not be like there will be no returns. There will be a negative return, in fact, over the long term, which is why they.
Well, looking at that yield curve, one thing is clear that investors are definitely pessimistic about the economic outlook. They expect that economy will perform worse in future. And we can make a conjecture based on the lines that yield curve is following through. Hence, the central banks will perhaps lower the short-term interest rates in response to a weakening economy. When a yield curve inverts, cost of borrowing also increases. This will discourage from borrowing. This will discourage businesses from borrowing. They will not invest in short-term projects. This will slow down the economic activities. And of course, we also see consumer sentiments also getting negatively affected. Of course, inverted yield curve is not a full proof to make those conclusions. But this fact, studying the yield curve, many economists, many policymakers, many investors, they assess the state of the economy. Central banks, they do not control long-term interest rates directly. Whenever RBI is playing with interest rates, these are short-term interest rates, because that is the only thing in their control. It is then the effect of the short-term interest rates, the effect of these rate hikes, that will then affect these yields, be it in the FD rates of HDFC or even the Indian government bonds, bond yields. So when RBI plays with interest rates, it also influences the Indian government bond yields. So let's look at a video that will make things and discussions very clear. And from now on, if in the newspaper or in the economic survey, which will come across this term, or even in UPSC papers, you can come across this term, you should be remembering this discussion about yield curves. What is it? What does inversion mean? Is it a good sign for the economy or a bad sign for the economy? But let's look at a video. Should be very clear to you now.
In 1980, the US economy went into a recession.
Automobile production dropped 37.5%.
Wall Street reacted very badly.
But that recession actually could have been predicted if you were looking at a very specific type of line. You see, normally this line points slightly upward, like here in September 1977. But about a year later, it started pointing the other way, just slightly. And then not long after that, boom, the 1980 recession. It happened again a few months later. The line curved downward, then boom, another recession. And it happened again in 1988, again in 2000, and again in the mid-2000s. This line is called the yield curve, and it's predicted every recession in the past half-century. And that's why some experts freaked out when this happened.
A recession warning.
Inverted yield curve. An inverted yield curve.
Inverted yield curve.
So, what the hell is this line? It all starts with a US Treasury bond. A bond is basically an agreement saying if you lend the federal government, say, $100, they'll pay you interest while they hold on to your money, until the date they agreed to pay you back. And the longer you let the government keep your money, the higher the interest rate, so you get more money. Next, you need to understand that most people don't buy bonds from the government. They buy and sell them from each other in the secondary market. And the prices change based on how much demand there is for a bond. This basically means that the amount of profit you can make on each bond changes every day. Still, the basic rule holds. If you let the government keep your money for longer, you'll yield more money. Trace these bars on any given day and you get a curved line showing the yields of different bonds, or what people call the yield curve. And normally it points upward. Now here's where things get more complicated. Let's say you're an investor and you have a hunch that an economic downturn is coming in the near future. If your hunch is correct, that means that if you buy a 2-year bond, you might get your money back in a bad economy, and there might not be anything good to reinvest in. That makes a 2-year bond a lot less attractive to you. And if lots of other people think this way, then the demand for 2-year bonds plummets. So they start selling for cheaper. But because the 2-year bond now costs less, it yields a better return relative to that low cost. And at the same time, investors who think a downturn is coming might think, I'd rather invest in a 10-year bond that pays out way later, when I think the economic downturn will be over. So that bond gets more popular, but it also gets more expensive. So investors start yielding less money. And if enough investors are acting on this expectation, the yield on a long-term bond, which is almost always higher than a short-term bond, can actually dip lower. And if you draw that yield curve, you can see that it goes in the other direction. It inverts. In other words, when this chart looks like this, it means investors think an economic downturn is probably coming in the near future. And that's what's happening now. So, is a recession coming? Not necessarily.
See, one thing is, I will keep on repeating many of the important concepts. I am cognizant of the fact that most of you are new to economics, and most of you will be able to understand 60-70% of it. That's totally fine. Even if you rewatch the recordings and understand 60-70%, that's totally fine, because along the journey, things will become clear. You should not stop learning. You should not stop attending classes. You should not stop watching videos just because you could not understand 10% or 20% or 30%. We will repeat concepts and I will make sure that you learn things. It's a new concept, getting introduced to it for the very first time. But from here on, if and when you read the newspapers, you will have a new picture to it. You will have much more better perspectives about Pakistan's economy than you did before you attended today's class. I want you to solve a question that has been asked in the UPSC. This was asked 2 years ago. It was considered to be a difficult question, but honestly, it's an easy question. So let's give it a try. This was asked last year, not even 2 years ago. Everyone give it a shot. Try your luck. We've discussed a few things, and I have cautiously not told you everything because you have to apply your mind and brain. Okay, so who will answer this? And you have to explain this also to the class, whatever answer you are coming up with. Ananya?
So the answer would be option D, 1, 2, and 3. So I know for a fact that the Fed and its decisions affect the monetary policy and the repo rate that the RBI decides. So we cover option 1 and 2 from there. And then for the third option, so it talks about interest rate in the short term. So if I see that the short term interest rate is low on a fixed deposit, let's say, and it's higher on a bond yield, so I would invest in the bond. So I came to it to that.
Good. Swati? Your rationale?
So yeah, like the actions of the Federal Reserve definitely affect global financial markets, so it affects us. So option 1 is correct. Option 2, definitely RBI also tweaks its policy, like increasing the repo rate. So that can lead to a decrease in the demand for government bonds, and which can result in higher Indian government bond yields. And then naturally, inflation and short-term rates. Investors prefer to invest in short-term securities rather than long-term bonds.
Okay.
So that can lead to an
Now,
increase.
can you explain what's the difference between government bond and treasury bills?
Indian government bonds and US
Government
treasury.
bonds and treasury bills, doesn't matter. Bills, bonds, difference.
I'm not sure. I don't know the difference.
So one important difference between government bonds and treasury bill is the tenure, the time it takes to reach its maturity. Government bonds have a longer tenure versus treasury bills. Treasury bills have shorter tenure. We will study all this in capital markets. If you are not getting it, totally fine. We will be repeating many of these concepts. It takes time to acclimatize to these things. So when we say government bonds, Indian government bonds, we typically refer to slightly longer tenure ones. Meaning, so Government of India issues debt securities called government bonds. It also issues treasury bills. Government bonds will have longer tenure. Treasury bills will have shorter tenure. As is the case with any kind of debt, what's the thing? The common thing. The common thing is that you have to pay interest on it. So Government of India also pays interest on it if they ask for money. No free money in the world. And whatever interest that the Government of India will pay, whatever interest that the Government of India will pay will be, of course, be impacted by inflation and the current short-term interest rates. We discussed this yesterday, also briefly today. And RBI, of course, plays a lot of role there. So statement 2 and 3 are definitely correct. No doubt about that. The only option which has both statements 2 and 3 is option D. So option D is correct. But UPSC will not repeat questions. It will repeat concepts and patterns. So it's important that you understand those concepts. Now, can anyone tell me how Indian government bond yield will be influenced by the actions of US Federal Reserve? Himanshu?
So, it's basically attracting money. If US Federal Reserve is lowering the rates, people, what usually they do, they take loans from the Federal Reserve and reinvest them in Indian market. So if government raises the interest rates and they are significantly higher than the Fed's rate, and people have that margin to reap profits, that's why it will affect the government bonds.
Okay, hold on. Let me cold call someone just to check if they are understanding this. Mansi, what do you think? Can you explain why Indian government bond yields will be influenced by the actions of US Federal Reserve? Just think logically.
Sir, as the government bond yield of US increases, so they are more attractive for the investors. So the investors, rather than investing in Indian government bonds, they'll shift to the US market. So in that sense, the bond yield of Indian government will reap lower investments.
Okay, hold on. Now let's assume that we have no idea about this, but we know about one thing. We live in a global economy. We live in a world which is interconnected. There's interconnectedness of global financial markets. Even from our logics, we can make a conjecture that US will play a role there. US plays a dominant role in global economy. Whatever US does will have impact in Japan, Switzerland, UK, and of course India. If US Federal Reserve changes its interest rates, world gets to know about. Even if you were to read today's newspaper, you will stumble upon what's US doing, what's not US doing, because it impacts us. If US Federal Reserve changes its interest rates, it can cause investors to then adjust their own expectations for returns from different asset classes, including bonds. Can anyone give an example? How? I'll give an example. Let's assume that if US raises the interest rates what will happen? If US raises interest rates, US bonds will become more attractive to investors compared to bonds from other countries. What can this lead to? This could lead to capital outflow from India. And that capital outflow from India will surely affect the bond prices in India, perhaps increasing its yield. There is so much of outflow happening from Pakistan, such an unstable economy. Look at the interest rates that they're offering now, 20%. Let this sink in. Yield curve. We will make use of this whenever we're writing answers in UPSC. We might even draw a diagram for extra marks. Now let's look at a new concept. And that concept is inflation. Let's watch a video. I'm not sure if I'll be able to finish this in next 20, 25 minutes, but at least I'll start a discussion around this.
In 1973, Japanese housewives going to market were faced with an unpleasant fact. The cash in their purses seemed to be losing its value. Prices were starting to soar as the awful story of inflation began to unfold once again. The Japanese government knew what to do. What's more, they were prepared to do it. When it was all over, economists were able to record precisely what had happened. In 1971, the quantity of money started to grow more rapidly. As always happens, inflation wasn't affected for a time. But by late 1972, it started to respond. In early 73, the government reacted. It started to cut monetary growth, but inflation continued to soar for a time. The delayed reaction made 1973 a very tough year of recession. Inflation tumbled only when the government demonstrated its determination to keep monetary growth in check. It took 5 years to squeeze inflation out of the system. Japan had attained relative stability. Unfortunately, there's no way to avoid the difficult road the Japanese had to follow before they could have both low inflation and a healthy economy. First, they had to live through a recession until slow monetary growth had its delayed effect on inflation.
Inflation is just like alcoholism. In both cases, when you start drinking or when you start printing too much money, the good effects come first. The bad effects only come later. That's why, in both cases, there's a strong temptation to overdo it, to drink too much and to print too much money. When it comes to the cure, it's the other way around. When you stop drinking or when you stop printing money, the bad effects come first, and the good effects only come later. That's why it's so hard to persist with the cure.
Oh, the first.
I thought let's have a Nobel laureate explain you what it means. Did you understand it? What is inflation? Of course, people will question him and we'll talk about his definition also. But what is inflation? The person we met a few seconds ago is Milton Friedman, a renowned American economist. He received Nobel Prize in economics in 1976 for his incredible research on income, consumption, and developments in monetary theory. Milton Friedman was a strong advocate for free markets. He believed that the role of governments in the management of economy should be limited. He popularized many concepts and theories in economics: natural rate of unemployment, quantity theory of money, permanent income hypothesis. We will learn about some of his work in time to come. His theories, some of it may not be part of UPSC syllabus, but I will teach you because this will help you get extra marks in the examination. Easy concepts. If you can write this in exams, we have to fetch every mark. Say syllabus is important. Many people study keeping syllabus in mind. But you will not always get the rank if you restrict to exact pinpointed word by word syllabus. We have to have some additional things to work hard to learn those things. But for now, let's talk briefly about one of his quotations about inflation. Milton Friedman said, "Inflation is always and everywhere a monetary phenomenon." What does it mean? Friedman said, inflation is always and everywhere a monetary phenomenon. Sahil?
He mean that it only depends upon the amount of money that is in circulation in the economy.
Rutuja?
So I would continue with the same. Inflation is in terms of monetary phenomena. So inflation is affected by the monetary policies. So like interest rates. Then as he mentioned, I'm not remembering this much.
Okay. Himanshu?
I think he means like, since everything we use, it's like we need money to buy all the commodities we need. So if inflation is there, means if money supply is more, then inflation will be in every sector.
Let's assume that I give you this as a question UPSC means. Inflation is always and everywhere a monetary phenomenon, in quotations, Milton Friedman. Explain, elaborate, discuss. Tell me. How will you write? What will you write? You will be better able to address this question, I think, tomorrow. Sorry, in the next class that we will have. But still give it a try. Angad? Avdut?
So, inflation is related to monetary policy, and as far as we have learned, monetary policy is related to the supply of money in the market. So, if we increase the supply of money in the market, the inflation will increase, and if we decrease the supply of money in the market, the inflation will decrease. That is what Friedman means in the same.
Okay. So this statement of Milton Friedman, it emphasizes on one fact and one fact alone. And that fact is inflation is fundamentally caused by changes in money supply. According to Milton Friedman, if a country's government or central bank, they increase the money supply rapidly compared to the economic growth, it will result in too much money chasing too few goods and services. And when too much money chases too few goods and services, it leads to higher prices, aka inflation. Think about this. If money supply is increased slowly and it is in line with economic growth, it will not cause significant inflation. Of course, this theory is not universally agreed upon. Many economists counter this. Keynes will have different views on this. But just for now, what is inflation? Yesterday we learned that inflation is the rate at which the general level of prices for goods and services is rising. And as a result, the purchasing power also falls. Essentially, inflation reflects a decrease in the purchasing power of money. What it means is that each unit of currency buys fewer goods and services now. Discussion of inflation happened in the first class, happened in second class, will continue to happen until our last class. So don't worry, just see what all can you learn in every class. Typically, when you hear inflation, you will see three categorizations of inflation. One will be from the demand side inflation. Second would be the supply side inflation. Third is stagflation. Demand side inflation. Let's talk about that. Demand side, also called as demand pull inflation. It is the most common type of inflation. Why? Why is it considered to be the most common type of inflation? Because if you think about it, it is caused by an increase in demand for goods and services relative to supply. So when we say too much money chasing too few goods, it essentially refers to demand side inflation. It's also called as demand pull inflation. Common type of inflation. It is closely tied to the cycle of economic growth. Think about what happens in a healthy economy. Just imagine that it's a very healthy economy. What will be the signs of that economy? Daisy? Or let me check with Twinkle. What is the sign of a healthy economy?
So the GDP grows, which means that the GDP per capita will
Forget about
also
GDP. What will you think about yourself? Think at micro level.
I hope my income also increases with the growth in the economy.
Yeah, in a healthy economy, it's a growing economy. You will be employed. Employment levels are high. Consumer confidence is high. Consumer confidence is strong. Strong is a word that they use. Businesses are expanding. Sign of healthy economy. But because of these things, what will happen? What do these conditions lead to? These conditions will lead to what? Increased spending by consumers and businesses. You have the money, you have the jobs, business is growing, you will spend a lot. And when this growing demand outpaces the economy's ability to produce goods and services, it can lead to what? A general rise in price levels. Imagine that you have a samosa stall. And that samosa stall, you recorded a video, collaborated with influencers, gained a reputation for making the best samosa in your city. News spread. Many people then started frequenting your samosa stall. What will happen? The demand for that samosa will skyrocket. But there is a limit to how much samosas you can produce in a day. Many constraints. There's a limit on number of employees, hours of operations, availability of ingredients, cooking equipments. But if the demand for samosa exceeds the stall's capacity to produce them, a shortage will occur. And in response to this increased demand and limited supply, the owner of samosa stall will do what? It will raise the price of the samosa. Why? Because there are more customers willing to buy samosa than there are samosas available. This is a very simple example. of demand pull inflation on a microeconomic level. The demand for the samosa pulls up the price. But if this type of situation, of this kind of situation, were to happen across goods, across services in an economy, you will see a general increase in price levels, which is what we refer to as inflation. So demand pull inflation is one of the most common type of inflation and results from the aggregate demand in the economy when it goes up. Now I want you to read a newspaper article for a few seconds, for a few minutes. And you need to tell me what does it mean. Because I know many of you will not read newspapers on your own. Let's do this to make sense of it. Notice the key words. What's the meaning of those words? Through its monetary policy intervention, central bank controls the demand side of the economy to keep inflation in check. Of late, inflation in India has been high. Ashwini, what does it mean? Rijuvana, can you explain? What are the key words here? What does it mean?
Sir, I think that to curb inflation, RBI will RBI can increase the interest rate so that the cost of borrowing will increase.
Hold on. I'm cautiously not using those supply demand graphs at this stage. We'll do it later, but I don't want to confuse you. Many are reticent of seeing those things. They don't want to see equations. So we are just solving things via common sense and whatever we're observing. But just listen to things carefully. This article tells us that RBI can do something to control demand side of the economy to keep inflation in check. Why not supply side? Because supply side is outside of the control of RBI. No? What constitutes the supply side? Amarjyoti, what constitutes the supply side?
The market.
Sainanda? Supply side.
The producer manufacturer side.
Labor, for example, the size of labor, the skills of labor, significant factors affecting the prices of goods and services in the economy. RBI has no direct control over demographics. It does not have control over immigration policy or education policy. For example, if there is a sudden decrease in labor force due to, let's say, aging population or mass emigration, not immigration, emigration to other countries from India, RBI will have no immediate tool to reverse it. Labor shortages can then lead to supply side inflation. Can you think of any example globally where labor shortages can perhaps or has led to supply side inflation? Japan. Significant portion of Japanese population moved into retirement. Japanese labor force has shrunk. Not only this, Japanese government has a very strict immigration policy. That policy led to labor shortages across various sectors of economy. And this labor shortage has contributed to inflation. supply side inflation, to be very technically clear. So I want you to now start using these terms, supply side inflation or demand pull inflation. Because as labor pool decreases in size, companies will have to increase wages so that they can attract workers, retain those workers. And this increased labor cost can then be passed on to consumers, will be passed in the form of higher prices for goods and services. Japanese case is unique because Japan has also struggled with deflation. Therefore, it has largely offset these inflationary pressures. Still, there have been many periods in the history of Japan where these inflationary pressures were because of labor shortages. Now they are collaborating a lot with Vietnam and a few other Southeast Asian countries. You cannot control supply side inflation with monetary policy. What if there is sudden increase in the oil price? RBI has no control over it. If a major oil producing country decides to cut its production, happens quite often, it can lead to higher oil prices globally, and this will affect the entire supply of goods in India. Why? Because oil is a commodity that is used by every sector, you name it, from logistics to infrastructure. Every sector requires oil. And this is perhaps the reason why the role of government becomes important in dealing with supply side inflation. Investing in technology. Why? When you invest in technology, what happens? Improved productivity in the economy. It may allow more goods and services to be produced with the same amount of resources. Labor laws, trade policy, tax policy, they all have significant impact on supply side of the economy. And these are the decisions taken by government bodies, not central bank. So the article that we just read tells us that RBI can do something to control demand side of the economy to keep inflation in check. Clear? Who is controlling demand side inflation? Who has more say over the supply side of things? Now I want you to read another article. Briefly, what did the article say? It said that RBI wrote a letter to the government explaining why it failed to keep inflation within the target band. So government in consultation with RBI sets medium-term retail inflation targets, 1 than 5 years. Failure to meet the target of 2 to 6% for 3 consecutive quarters required RBI to write a letter to the government explaining why did you miss that inflation target range. And in that letter, RBI blamed supply side issues for price rise. Yesterday, we learned about Black Sea Grains Initiative and Russia's withdrawal from that initiative. Right? We learned about that. And there's a high likelihood that decision, that action will perhaps lead to inflation in India. Now, Priyanka, my question is, what kind of inflation would that be? Supply side or demand side?
Supply side.
Exactly. Good. Because of Russia-Ukraine war, global wheat prices went up. Why? Because Ukraine is a major wheat exporter. Now, because of war, wheat production and exports are obviously disturbed. What can RBI do? Nothing. But Nishita, if you were in the government, perhaps as finance secretary, what will you do to ensure that wheat prices are stable regardless of the Ukraine-Russia war? Any thoughts, Nishita? You could be asked a question. This is a problem that you're facing. What steps will you take? Diksha? Sachin?
I'll probably ban the export of wheat from my country. To
banning everything is easy, right?
Like this is the first.
Will have consequences.
It will have consequences because we discussed all the economies are interconnected, and it'll might disturb the relations. So might ban certain
So
varieties.
deal with so many international organizations, deal with so many countries, build so many relations with so many countries. And when the time comes that when you can help them, you are deciding to ban it. But okay, fair enough. What else? Not just one thing. You will have to take multiple actions. I don't want to extend the class, but let me give you a few points. Perhaps government can provide incentives to increase domestic production. Could be in the form of providing subsidies for seeds, fertilizer, farm equipments. Government can figure out ways to invest in technology to boost productivity. Government can diversify import sources. And for that, our diplomats will have to come into action, participate in trade negotiations, forge new alliances, overcome logistic challenges. Government can perhaps use buffer stocks. Why do we have buffer stock? Release those stocks into the market, increase the supply, will bring down the price. Government can rightfully reduce or remove any import duties on wheat, making it cheaper to import from other countries, so that the end consumer does not face the brunt of the high prices. And of course, you can ban, but again, banning also has consequences. But there's so many other options left. Banning things, easiest of all things, should be the last resort. On the other hand, if government does not do anything, what will happen? If we have idiots occupying those important positions, what will happen? Wheat is not only a major input for many food processing industries, but also a very important determinant for the cost of living. If wheat prices go up, perhaps workers will demand more wages. Perhaps wages in the overall economy will go up. Firms will be left with no choice but to raise the prices for the goods and compensate for higher wages. And this is how a supply side shock can perhaps lead to general inflation across the country. And therefore, it becomes important why good people should occupy important positions in this country. Tomorrow is going to be an ethics class. There will be some pre-reads for it, which we will upload on the portal. We will also update this on the LinkedIn group, alumni group. I think it should be minor pre-reads. It will take some time for us to upload. And we might have an extra class on Friday. We might. Tomorrow we'll do the announcement. Okay. All the very best. We will continue our discussion on inflation and economy whenever we meet next, be it on Friday or Monday. Good luck.